Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we talked about the S&P 500 index, the good old SPX. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we looked at a put butterfly in the SPX. We had a big downturn in the markets that started on the half day of trading on Friday after Thanksgiving. So we saw a little bit of weakness in the marketplace. So I am highlighting the long put butterfly spread inside the options playbook right now. And when we're looking at butterflies, a lot of times butterflies are thought of as a neutral trade. In other words, you're going to put this peak strike B right around where the stock is currently trading. We decided there was a little bit of weakness in the marketplace. We looked at the chart. There was an area of support that at one point in time was an area of resistance. We decided to target that area with the butterfly. And the main reason why we did the butterfly was that the implied volatility had spiked. And whenever volatility spikes, butterflies become cheaper than they were because we're selling these two option contracts at strike B. So in our instance, the stock was trading somewhere up here, or I should say the index, the S&P 500 index, and we bought a long put butterfly on the downside. Now, there's been many opportunities to get out of this trade, but one of the things about the Stock Play of the Day, and we did mention this, that we always do it on Tuesday. The markets are open, they're live. If I was looking to do the trade, I might have waited a couple of days, you would have been all right, but you need time decay in order for this trade to pan out. You either need implied volatility to come down quite a bit, which is hard to do if the market is still falling. Or in our instance, we needed time decay. We did a very, very short trade. And well, let's get in. Let's look at what happened in the trade. Okay. So the markets right now, I have my VIX watch list up, which we look at every Tuesday on the Stock Play of the Day. And we see that the VIX right now is still above 30. So we still got a lot of volatility in the marketplace. The SPX is down 65. Wow, that just, the last time I looked at it, it was down 55 overall. We would need it to come back if you had not closed out the trade and basically rally into the close. And this could be a real good scenario here for our paper trade that we looked at. And so now this is the actual chart, and this was the area that we were targeting. So you can see this strong support area, and let me pull this down a little bit. And we still got the moving averages all in a row. We got, they're behaving nicely, if you will. We were up around this area 1, 2, 3 bars ago. And you can see that the SPX really struggled with this area right here. Now, we have a breakdown, and that is a bad thing overall for the markets if we do not rally back into the close. To finish below this line today, overall would be a bearish sign going into the weekend. It's just one indicator. You got a little bit of a bearish sign on the chart. You got the VIX trading up around 31%. That's showing a lot of angst in the marketplace overall, with the VIX being that high. So this would be a bad sign going into the weekend, just from those two little points overall. Okay, now the trade that we looked at. So here's a close-up. That's right. I forgot that I added this chart. Here's the close-up. This is a 15-minute chart. This is noon on Tuesday. That's when we taped the Stock Play of the Day. Markets were right around 45.75. 45.75. We looked at a long put butterfly that would basically try to, we're kind of targeting, hoping that the stock would hang out in this area right around where that support level is. Now, if we go back to this chart, this is that same line. We've just zoomed in on that line. So this is what the area that we targeted. And it did. It has hung out in that area quite a bit. This is the center of our butterfly, and that is a good thing. So this is all day Tuesday, all day Wednesday. We got all the way down to that area, hung out most of the morning on Wednesday, right at the center strike. And then this is all day Thursday. And here we are on Friday. We also, remember, these are 15-minute bars. So there was right at this area of support, the stock hung out, but now it has broken down. So now we're below the 20-day, below the 50-day moving average overall on the short-term chart. And you can see this little area here. This would actually, so we're flirting with a little bit of a dangerous territory since Tuesday. We're right down at the lows of the market so far this week on just the 5-day chart overall. But let's go in and look at the actual trade and see what happened with the trade. Now, remember, it was pure speculation. We did the butterfly because implied volatility went up. We were able to execute the trade. Well, we weren't able to execute. Remember, it's always a paper trade. Nothing's ever meant to be a recommendation when we talk about this stuff on the stock play of the day. But we were able, the market at the midpoint was trading right around 60 cents. That means for every 1 by 2 by 1 butterfly that we were doing, our total risk would have been $60 plus commission on that trade. It was a 15-point wide butterfly. So on the upside, you could make $1,500 or $1,500. But that means it's got to go out right at our center strike. So here's our chart. This is where the SPX is at right now. This is the put side of the market. We're now above the market because it's already came down through our butterfly and went to the downside. And if we look at the option strategy workbench here, we see that, wow, it's really moving. We're around, what do you say? Let's call it 190, 145, 180. I see 220. So you would really have to work this order because obviously with the markets doing what they're doing right now, there's these quotes are updating very quickly overall. But I would look to close it. Now, if I had this position on, we risked $60. If we did it a 1 by 2 by 1, for every 1 by 2 by 1 long put butterfly that we put on, it would cost us $60, and that would be our risk. If you did just one, you would probably let it ride, but you would always have an order in. And I would have had an order in if I had executed this trade. I would have had an order in the whole week, saying that if it got up to $5 or $6, that I'd be happy to get out. Very hard to make the maximum on a butterfly. You need the market to go right to your short strike, and you need all that time value on those short option contracts that you own to go away. It's the only way that you can make the maximum on that trade. We have a 30-point landing area, looking to get a little bit of a run into the market. We're hoping for a run up into the market. That right now, that level, kind of a weird level of support in the short term, might make the SPX bounce and rally into the close. Let's hope. Just overall for the marketplace would be a good thing. But if you can get out, you paid $60 for it. You can sell it, let's say $2. You're looking at $1.40 on a very, very inexpensive, very speculative type trade, trying to guess a landing area for the S&P 500 index. And the only reason why it was that inexpensive to put it on to start with, and I think that was pretty inexpensive, is because the implied volatility was so high. It's just that simple overall. So if we look at where we're at right now, this is the profit and loss graph. This is where the underlying stock is at. You have no days remaining to expiration. So ultimately, if the market does come back in this range, this spikes all the way up to the dotted line. Still a lot of premium that's in it, but right now, you would just hope that you would come back and you would land somewhere between 45.30 and 45.60. And if you don't want to, you could sell it right now and just get out and close the trade and hopefully receive somewhere around $2 for your 1x2x1 butterfly. You paid $60 plus commission for it. So you're looking at around $140 just in a short-term trade that was made on that speculative long butterfly to start with. Now, very simple. When the trade goes with you, there's really not much to talk about on the stock play of the day overtime. But I just finished a 3-part rookies course on option trading. We have it set up. I can't share the link with you, but if you go to the playlist on the ally.com YouTube channel or the Ally YouTube channel, you'll see a playlist for the rookies course. And feel free to share that link with friends, people that are interested in trading options. It was a 3-part series, very well received, and I would love to share it with you. And I would love it if you shared it with your friends and family. That's going to be it for this edition of the Stock Play of the Day Overtime. My name is Brian Overby, Senior Options Analyst. If you'd like to join more of these events, please click subscribe, ring the bell, and we'll see you this Tuesday for the next Stock Play of the Day. Thanks for coming, everyone.